We know the Reserve Bank is hell-bent on lowering unemployment, increasing our wages, increasing inflation, and it's doing that by lowering interest rates, and it's likely to do that again, as well as talking about other measures such as quantitative easing. But what if it doesn't work? What if the only effect of lowering interest rates is pushing up property values as it's happening, but the economy doesn't pick up? Well, that's a chat I had recently with Dr. Andrew Wilson in one of my weekly Property Insider videos with him, and today I'm going to play you the audio track of that because we discuss some really interesting things about the economy, what's happening overseas, what it means for you, me, our wealth, for interest rates and for our property markets. I bet you're going to learn something from Andrew's insights. But before we do that, I'm going to share a mindset moment with you, and I'm also going to share with you 5 lessons that you can learn from farmers. Now, I'm talking about property investment lessons, but interestingly, those lessons are relevant in many areas of your life, including business, including entrepreneurship, including success in other areas of your life. So by the end of today's show, you'll understand what we can learn from others, from farmers, and you're also going to have a better understanding of some of the drivers of our economy and what's going to happen to interest rates moving forward. So welcome to today's episode of the Michael Yardney podcast.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's most trusted property commentator who has once again been voted Australia's leading property investment advisor. That's the 5th time he's won a similar award in the last 7 years.
Today I'd like to share with you 5 lessons property investors can learn from farmers. Now you're probably wondering what's Michael on about, and I'll explain in a moment. But before I do, maybe I could ask you a question. How often have you thought to yourself, if only I had more money, life would be that much simpler? Do you feel like you've never got enough? Are you constantly spending your salary the day it lands into your account and then eagerly awaiting the next payday so your stocks are replenished and you can start consuming all over again? This is the unfortunate reality of the way most people survive their lives. They live to consume, and in turn they ultimately are consumed by the driving need for even more money. However, the problem with this logic is that often the more money that comes to you, when you have that type of mindset, the more you're ultimately going to spend. So I'd like to explain to you that farmers do things differently. They're producers rather than consumers, and they work towards growing something that one day will become something big. It starts off as a tiny little seed, but it grows. Smart property investors understand that they've got to nurture and grow their portfolios too, producing the returns they desire in favour of consuming everything that they've got right now. So rather than ending up with nothing to show for it when they finally retire, they grow their portfolio like a farmer grows seeds. They share the farmer's desire to see their efforts reap great rewards, and they understand the importance of these 5 farming lessons that I'd like to share with you. See, first of all, lesson number 1 is look at your salary or wages the way that a farmer looks at his seeds. In other words, instead of focusing on consumption and spending, think about how and where you could plant that income to create a return on your investment. This shift in your mindset from wondering what you can buy with your money right now to how you can make your assets grow for the future so you get cash flow and more in the future, so you get income and equity in the future. That shift in mindset is going to make a big, big difference. The second way I'd like you to think like a farmer is be patient and look after your investments the way a farmer tends to his crops. A farmer understands the cyclical nature of primary production, nurturing his crops after planting and allowing time and the seasonal influences to work their magic. As a property investor, you need to understand the same, the long-term market cycles, just like the seasons for the farmer. And they're the seasons of life, aren't they? And just like the farmer knows it takes time, you've got to understand it takes time in the market, and that will ultimately determine your capacity to produce a great post-work income through your property portfolio. Remember, wealth is the transfer of money from the impatient to the patient. Now, that was a quote from the most successful investor I know that's ever been born, Warren Buffett. The third lesson you can learn from farmers is be selective how you go about growing your asset base. Like a farmer is selective with his harvest. A farmer takes the best seed from the top of his harvest and puts it aside for next season's planting. He certainly doesn't scrape the bottom of the barrel, but instead he focuses on quality. So as an investor, you need to keep an eye on growing your portfolio and know when to take out some profit. Now, here's the important point. In asset building, in the investment phase of your journey, you should only take out profit to reinvest to accelerate your returns, just as a farmer re-sows the best seeds to make sure each new crop is more bountiful than the last. So remember, you go through 3 phases of your property investment journey. There's the saving stage where you save for a deposit. Then there's the accumulation stage where your property portfolio grows and your assets grow. And then there's the slower lowering your loan to value ratio stage where you slowly transition into the cash flow stage of your portfolio. But as you accumulate, as you grow equity in your portfolio, as your serviceability increases, as your rents increase, you should be replanting those seeds. You should be replanting that equity into growing your property portfolio. The fourth lesson you should learn from farmers is that each new cycle, or as a farmer, each new season, should be as a chance to grow your wealth. A farmer never ceases to look for opportunities to grow his crops. When the next harvest comes around, the cycle's repeated, and the accumulated effects of seed plus time plus harvest are repeated over and over again. So like the farmer, you don't want to consume the fruits of your investment labours, but you want to continue to look at buying new opportunities that are going to enable you to use that good profit that you're making to acquire even more good investment-grade properties like I just explained. And the fifth lesson I want you to learn from farmers is work your investment portfolio the way a farmer works his land. The farmer doesn't sit back and hope and pray that the season's harvests are going to be bountiful. Instead, he's proactive in nurturing his land, in ensuring his crops are fed, they're watered, they're weeded as necessary. Same with the property investor. The lesson is to be an active participant in the growth and sustainability of your portfolio. This means taking care of your investments, regularly reviewing your portfolio, seeing how its performance is going, protect them with the right asset structures, the right cash flow buffers, the right insurance. It also means keeping a close eye on the performance of your properties and, if necessary, doing a little bit of weeding if you've got underperforming assets that are threatening your harvest. Now, that's hard to do. It's hard to do because most people are subjective. They can't see how badly some of their portfolios is performing. And we see that regularly when we do portfolio reviews with clients at Metropole. Not the properties we've bought them, but properties that they've bought themselves beforehand. And so it's often useful to sit with an outsider, somebody subjective, somebody like one of the property strategists at Metropole, to review your portfolio and ask, well, how's this property performing? Is it performing like I expected? Knowing what I know today, would I buy that property again if it was on the market? And if not, I guess one of the questions you've got to ask yourself is, why do you still own it? Now, if it's not performing well, it could just be because it was a bad stage of the cycle. Maybe it's something you just got to wait for a while. Maybe you need to change your property manager. Maybe you've got to improve the property, renovate it. But if it's a dud's always going to be a dud. And because your money's eventually going to run out and you can only own so many properties, the answer is you've got to own the best properties you can. Remember, a smart property investor is about nurturing those long-term returns, so he's going to ultimately, or she's going to ultimately produce at the end of the day a portfolio that's going to give them the financial freedom they want. So to find success in growing your own crop of high-growth assets, you must change your focus from consumption to production. It's really that simple. But maybe it's not that simple, because I find most property investors get in their own way. Their irrational thinking stops them getting the property returns that they deserve. So if you're looking at buying your next investment property or a home, there are a number of ways the team at Metropole can help you. And I'd just like to quickly discuss those with you before we get into the next segment of this show. And sure, our property markets are improving, but even more so than ever, correct property selection is going to be important, because we're in a phase of increased growth, but not boom times. So you've got to select the right segments of the property market that are going to outperform. And you've heard on previous shows how we do that. But if you're not sure where to start, if you're not sure how your portfolio is performing, if you want an independent view on how it's going, why not get the independent team at Metropole to have a chat with you? Now, we are buyer's agents. We have a team of buyer's agents. We're also property strategists who actually put a strategy to you, and then the buyer's agents implement that strategy. But if you want to become wealthy, you're going to need more than just a buyer's agent. And you're actually going to need more than just a property strategist or a combination of the two. You need a team that have got a holistic approach, understanding tax, finance, wealth, insurance, property, tax. I think I said that already. So you need somebody on your side levelling the playing field. And at Metropole, we help our clients grow, protect and pass on their wealth through a range of services. We can give you strategic advice. We can build you a strategic property plan which brings your future into the present so you can do something about it. Our buyer's agents are Australia's most trusted buyer's agents and have been involved in well over $3 billion worth of transactions, creating wealth for our clients. We have our own on-the-ground teams. We don't fly in and out. Our own teams in Melbourne, Sydney, Brisbane. Our wealth advisory division, run by Ken Race, and our financial planning division can give you the tailored advice you require. We have property management, renovations, development. That's what I was actually saying, a holistic approach. So go to metropole.com.au, find out all about how we can help you, because I'd like to be part of your wealth creation journey.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In my mindset message today, I'd like to share with you a lesson I learned from one of my early mentors, Jim Rohn, who I often quote. And he taught me that spring is the season of opportunity, and he explained not to waste it. Now, he's not just talking about spring, the season in the calendar. Metaphorically, he's talking about spring, the season in your life. Now, a couple of months ago, I was telling people, don't be worried about the winter of the property market, because I explained that for thousands of years, spring has followed winter. And look what's happened. The property market has turned. The cycles move on. That's a lesson I learned from Jim Rohn. So let me share with you something he taught me, because he said the following. He said, I know the following things to be true. Life is about constant, predictable patterns of change. Rowan taught me the only constant factor is our feelings and our attitudes towards life. He said we've got the power of the attitude, and attitude determines our choices, and the choices determine our results. Now, I've explained that to you in a different way, that your thoughts lead to your feelings lead to your actions lead to your results. We're saying much the same thing, that the inside world, your thoughts, your feelings, your habits, determine the results that you get. So Rowan taught me, you can't change the seasons, but he taught me that you can change yourself. He said, I'm convinced that as human beings, it's our natural destiny to grow, to succeed, to prosper, to find happiness while we're here. To do that, he explained, you must make constant and conscious efforts at improving yourself in the face of changing circumstances. I guess that's partly why I share these mindset messages with you, because I know you want to know about property and money and success, but in my mind, it's the mindset that makes a big, big difference. Okay, so let's talk about spring. According to Jim Rohn, spring's the season of activity and the opportunity that follows the turbulent winters. It's the season for entering the fertile fields of life with seeds, with knowledge, with commitment, and with determined effort. However, just because spring arrives doesn't mean that things are going to look good in autumn. Jim Rohn taught me you must do something with the spring. He said everyone has got to get good at one of two things, either planting in the spring or begging in the autumn. So he said, take advantage of the day and the opportunities that spring can bring. That's the message I'm trying to give you in this podcast. Take advantage of the opportunities the property market is giving you at the moment. Anyway, back to what Jim Rohn taught me. He said, some people plant in the spring and leave in the summer. And if you've signed up for a season, see it through, he said. You don't have to stay forever, but at least stay until you see it through. He said, it's the promise of spring that as we sow, so shall we reap. For every disciplined human effort, we're going to get multiple rewards. Jim Rohn explained that for each cup planted, a bushel's reaped. For every good idea given to somebody else, many others are going to give us good ideas in return. For every act of love you give, a life of love is returned to you. So just remember, it's a natural characteristic of springtime to present itself just for a brief period of time, or to lull us into inactivity because you're seeing all this bountiful beauty. And Jim Rohn cautioned us. He said, don't pause too long to soak in the aroma of the blossoming flower, lest you're going to awaken to find spring is suddenly gone and you've still got the seeds in your sack. So what he was trying to tell us is that with intelligence, with wisdom and freedom of choice, they're the things that us humans have got. We should exercise the discipline to plant, despite the rocks, despite the weeds, despite the other obstacles that are in front of us. The rocks and the weeds and the thorns of the world cannot destroy all the seeds if you plant massively enough and intelligently enough. Now, there's a good message, isn't there? Because there are rocks out there. There are thorns out there. There are difficult times out there. So Jim Rohn's teaching us that what you've got to do is plant massively enough. Choose action, not rest. Choose truth, not fantasy. Choose a smile, not a frown. Choose love, not anonymity. Choose a good life in all things of your life, and choose the opportunity as well as the chance to work when spring smiles on your life. Spring shows that life truly is a constant beginning, a constant opportunity. Yes, you can have a constant springtime if you walk around with your glass half full. Jim Rohn went on to explain we only need to look at life once again like we did as a child, letting fascination and curiosity give us welcome cause for all the miracles that are around us. So my suggestion to you is get busy quickly on your springs, on your opportunities, because there are just a handful of springs that have been handed to each of us. Life is brief, even at its longest. So whatever you're going to do with your life, get at it. Don't just let the seasons pass you by. The Reserve Bank's third reduction in cash rates in 5 months is their attempt to increase employment and lift stubbornly low inflation. Now, the long-expected move follows clear signals from Governor Philip Lowe that the Reserve Bank was prepared to push interest rates lower to increase employment and to lift stubbornly low inflation. But what if it doesn't work? What if the desired effects to the economy don't happen and the only effect is property prices keep moving up again? To help understand what's going on, let's have a chat with Dr. Andrew Wilson, Australia's leading housing economist and chief economist of myhousingmarket.com.au. Welcome, Andrew.
Thank you, Michael. Yes, thank you for that, and welcome to you too.
Now, it seems the Reserve Bank's aware that low interest rates may backfire. In the most recent minutes, they said it was possible that low interest rates may be starting to have a negative effect on income and confidence of savers. And in their minutes, the board members said policy stimulus might be less effective than past experience suggests. They said the negative effect of low interest rates on income and confidence may make it harder for savers, and that may be a significant factor in what's going on. But they're also a bit concerned that house prices may go up. So what's going on, Andrew?
I think it's a bit of a mess, Michael, don't you? I don't think the Reserve Bank is quite clear in understanding what's going on. Could be this, could be that. This might work, this might not work. But unfortunately, we haven't got a lot left to stimulate our economy now, and what's been used so far hasn't worked. In fact, our economy seems to be going in the other direction, and of course that conversely might be a result of cutting interest rates. So it might be interesting to the Reserve Bank to see this new paradigm emerging in terms of monetary policy, which to my mind has been apparent now for years, but it's not going to be terribly comforting for those that are looking for prosperity to re-emerge in the Australian economy, because we're a long way from that, Michael.
I know we have been speaking about this regularly in these regular weekly Property Insider chats, where you are suggesting that lowering interest rates hasn't worked overseas, so why should it work here?
Well, that's right, Michael. I mean, in some respects, we are constrained by downward movement in interest rates overseas because, of course, we need to keep our currency in reasonable balance with the rest of the world to support our export industries, which, of course, are a very positive part of our economy at the moment. And we really are entering an economic deep freeze to some degree. And what disturbs me most, in a sense, is that we still get the mantra of commentating regarding house price growth. That obsession got us into this situation in the first place. Moving forward, I think that really we've come to the end of the road in terms of looking for some stimulus as we've had traditionally from lower interest rates. And as you suggested, Michael, it may actually be having a negative effect on the economy in terms of sentiment. Obviously, the wealth effect from savers who are looking for bank deposits is declining. And even though we're getting some hysterical response to recent growth in house prices, which has more or less been restricted to the Melbourne and Sydney markets.
But they're out there again. They're talking about a property bubble, Andrew.
Well, it never occurred in the first place, and that's almost been accepted as truism. And now we're looking for a so-called repeat of something that never happened in the first place. What disturbs me is the language from the Reserve Bank is still talking about issues to do with house price inflation and how that would need to be addressed. And the very fact that they're talking about that again in the midst of this wasteland that's occurred, not just in our housing markets, but in our general economic performance, as I, in my opinion, believe was a direct result of taking the eye off macroeconomic ball and focusing too much on Sydney and Melbourne house prices 2 years ago, when the real issue is to try to get income growth up, inflation up, and to stop unemployment from rising, which I believe we're now going to start to see an upward trend going forward.
Well, the Reserve Bank noted in their minutes that the recent forecasts that they had on unemployment and inflation for the last couple of years, in their words, is likely to be short of the bank's goals. They're admitting that it's not working. They're not going to be able to bring unemployment to the levels they're hoping for, or inflation up, or wages up. And recently, retail figures confirmed that spending intentions fell back again, adding to our economic concerns.
Well, this is all adding up, isn't it, Michael? I mean, the only consistency here is how consistently wrong the Reserve Bank's been in terms of its forecasts. The IMF has come out and they too have had to downgrade all their forecasts. Look, we've just fallen into the trap of expecting traditional macroeconomic policy to work. It hasn't worked. It hasn't worked for years. And we need to start thinking outside the square. And it's easy to say, well, we've either got monetary policy or fiscal policy, and if one fails, we move to the other. But we have a government here who's obviously going to be reluctant to move into a deficit environment, even if it means trying to stop cascading unemployment rates. And I'm not sure even if fiscal policy was reversed and we did go into some sort of a deficit environment, that we would, in the short term at least, create the jobs that we're going to need pretty soon to try to stop that unemployment rate rising towards 6%. And all this gobbledygook about quantitative easing, which I think most people who commentate have no idea what it actually means. I don't think that's going to be a solution either. It hasn't been overseas. Why should it be here? We haven't learnt the lessons from what's gone wrong overseas in their policy settings, and yet we still seem to be transfixed on following the old rules, even when they haven't worked.
As you said a moment ago, the IMF has slashed global growth in general, the outlook for global growth, and also downgraded its forecast for Australia below what the Reserve Bank's forecasts are. So they're suggesting Australia's economy is going to grow 1.7%. Now, again, we're not falling into recession, so we're not using the R word. We're not trying to scare people, but we are trying to say that there's actually little room left for mistakes from policymakers, and there is an urgent need for policymakers to cooperate. But recently, Treasurer Josh Frydenberg, he seems reluctant to put his hands in his pockets to stimulate the economy. He seems more keen to follow that political promise of, first of all, delivering a surplus, saying it's going to help the government meet the challenges in the time ahead. How about helping the economy now, Andrew?
Exactly, Michael. And it's the old tension between good politics and good economics. I'm not sure that continuing to drive towards a budget surplus, particularly when one of the old traditional arguments against deficits was the fact that you'd have to pay a higher interest rate. You know, in a global monetary system where interest rates are around zero, I'm not sure that that's going to make a big difference, particularly in an environment where our current account is looking a lot healthier than it has through our export performance. These are very vexed times for policymakers. It is difficult for them, of course, to push outside the square. But I think after years of failure in terms of predictions, in terms of policy setting outcomes, I think it's time to start being a little bit more realistic about that failure and start to look at some more worthy alternatives. The main game here is to keep people in work. We've been able to do that without incomes growth. But if we have low incomes growth and higher unemployment, that really is something to be worried about, Michael.
Well, let's put a little bit of a good spin on. While Germany, the United Kingdom, Singapore and another number of other economies experienced negative growth in the June quarter, Australia's economy still did grow faster than all the G7 nations other than the United States. And the International Monetary Fund did seem to endorse the Reserve Bank's 3 rate cuts, saying it's the job of central banks to reduce risks by easing interest rates, but they did also suggest that government's fiscal policy should play a more active role as well. Monetary policy can't be the only game in town, so maybe it is time for the government to put its hands in its pockets. What's going to happen to interest rates, Andrew?
Well, the Reserve Bank in its minutes said quite clearly nothing's worked. Lower rates may be having a negative effect. And then they've said, but we'll cut rates anyway. It's like, what? So it hasn't worked. There are risks involved with lower rates, but we're going to continue to cut rates anyway. There's growing speculation we may get another cut this year. That really puts us towards ground zero and with nothing left. And the Reserve Bank also in its minutes mentioned that there was an argument that perhaps Reserve Bank should keep some of its ammunition handy in terms of interest rate capacity in case there was an economic shock. And it answered that by saying, well, the research told it and the experience told it that it wasn't so much the cutting of rates that stimulated the economy, it was the level at where rates were. And I thought, well, we've never had rates this low before. So I'm not sure what the experience or the research counts for. Let me tell you, it counts for absolutely nothing. And I think that when you mount that argument that it's about where the rates are, not the capacity to cut, when you've got a rate potentially at 0.25% or even zero, that whole argument of experience and where rates have been previously, which of course has been much, much higher, is just ludicrous. I think we need to have the capacity to cut rates in case we do get an economic shock. Global economy, as the IMF has stated, is looking a little bit ordinary at the moment. It's something we should be mindful of to keep something in reserve, particularly given that lower rates aren't working. Neither are tax cuts. And as the Reserve Bank has said, it may actually be having a negative effect on the economy.
Well, it's having a negative effect on consumer sentiment because people are getting concerned. They're stashing their cash, they're paying down their debts. And to a degree, that bit of it is good. But we do want people to spend and grease the wheels of industry and keep jobs going, keep retailing going. So some interesting times ahead. We're going to catch up once a week on Property Insiders to keep people informed on what's going on. Thank you very much for your time, Andrew.
Thank you, Michael.
As we're nearing the end of another show, I'd like to say thank you for listening, and I hope you got some benefit from it. And if you do, I'd like you to help me on my quest to make as many people more financially literate. I'd like you to pass the details of this show on to somebody so they can learn as well. Now, at the bottom of every podcast app, there's a share button. Just click on that or tell somebody about the show. That'd be great. And if you want to tell the world about the show, I'd appreciate it if you left a review on iTunes or Stitcher or wherever you listen to this show, because that passes the message around to people as well. And when you do, I'm going to say thank you by gifting you a copy of one of my books. Now, recently, Nickel Pickle Tickle, that's a nice name, from the United States, left a review on iTunes, Universal Investing Concepts. Thank you, Michael, for all the sound investing guidance and information. I live in Eugene, Oregon, the United States, and although much of your focus leans towards Aussie markets, your overall mindset, advice and investing experience very easily and effectively extrapolates to my markets in the US. Thank you so much, Nickel Tickle Pickle. Oh, I apologise, I even said that wrong. It's Nickel Pickle Tickle. But I know we have a very large audience around the world. I see that from our iTunes statistics. And I like growing our audience, so I appreciate when you leave a review. And if you hear your review read out and you email me, michael@metropole.com.au, I'd love to gift you one of my books. In between these twice weekly shows, you can find out more about what's happening in the property markets, about tax, about finance, about wealth, about success in my daily property update newsletter. Just go to propertyupdate.com.au and subscribe. And if you enjoyed my chat with Andrew Wilson, and if you want to get our weekly videos, go to our YouTube channel and subscribe at propertyinsiders.info. And you can keep up with me on all the social media. But in particular, more recently, I've been spending time on Instagram, where you'll get some insights about me as well as about property. Just follow me, Michael Yardney, at Instagram. I'd love to catch up and learn more about you too. I look forward to catching up with you again real soon. Twice a week, you're going to get these episodes of the Michael Yardney podcast. So in the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?